Health savings accounts. Let's cash in.
Finance for the everyday millennial. Hard charging solutions. We provide an accelerant in the journey towards financial independence.
Welcome back to Cash In with Cassian, the financial forum for young professionals. Today we're all about feeling good and saving money at the same time. They say if you have your health, you have everything. That may be because if you're in good health, you're probably not buried under a ton of medical debt. While most health insurance plans offer basic care like your annual checkup at no cost, an unexpected medical expense can be a budget buster. Take my friend Barb, for example. Her sore throat turned into a full-blown case of strep. Her primary care physician was booked up for the week, so Barb decided to pop into the minor emergency clinic near her house to get a prescription for the antibiotics she knew she needed. In under an hour, she had seen a doctor, gotten a throat culture, and received her script, all for about $300. It turned out that the clinic was out of network and the throat culture wasn't covered by her health plan. Barb had to foot the bill for everything, but it wasn't a total financial disaster. Her high deductible health plan came with a health savings account, or HSA. When it came time to pay, Barb used her HSA debit card and was able to use money she'd set aside specifically for health costs to pay the bill. At this point, you're probably asking, what's an HSA and how can I get one? An HSA is a tax-advantaged medical savings account. HSAs are available to taxpayers who are enrolled in high-deductible health plans, or HDHP. A high-deductible health plan is exactly what it sounds like. A health insurance plan that offers coverage but carries a much higher deductible than traditional health care. In order for a high-deductible health plan to qualify for an accompanying HSA, the plan must meet certain criteria established by the IRS. In 2022, HDHPs for individuals must have a minimum deductible of $1,400 and an out-of-pocket maximum of at least $7,050. Family coverage HDHPs must have a minimum deductible of $2,800 and an out-of-pocket maximum of at least $14,100. The high deductibles and out-of-pocket costs allow insurers to offset some of their underwriting risk for the plan, which translates into lower premiums for the policyholders. Many employers are starting to trade their traditional PPO or HMO coverage for high deductible health plans because HDHPs are far less expensive to administer. Here's how health savings accounts work. HSA owners make contributions into their accounts either through a payroll deduction or by directly depositing money into their account. Employers who offer HDHPs may also contribute money directly into their employees' HSAs. Once the money is in your HSA, you can withdraw it as needed to pay for qualified medical expenses such as doctor's visits, prescriptions, and many types of medical procedures. You can even use your HSA funds to pay for dental work, an eye exam, or your insurance plan premiums. It's important to know that any money your employer deposits directly into your HSA is yours to use without any time for vesting. Regardless of who makes the contribution, the money in your HSA will always remain free of federal income tax, so long as you use it to pay for medical expenses. As with any type of tax advantage plan, there are a few rules that govern how HSAs work. The first thing to know is that there is a limit on how much you can put into your HSA every year. For 2022, the maximum contribution amount for an individual plan is $3,650. Family plan holders are limited to $7,300 in total contributions. There's no deadline for using up your HSA money, so you can roll over any end-of-year balance in your HSA indefinitely. Once you hit the age 65 and enroll in Medicare, you can no longer contribute additional money into your HSA. Any funds that you have in your HSA remain in your name, and you can continue to use them to pay healthcare expenses. You just can't add into the account. If you enrolled in TRICARE or TRICARE for Life, or if you are covered by medical benefits from the Veterans Administration, you cannot open an HSA. However, if you had an HSA from a previous health plan, you can still use that money to pay for any new qualified healthcare costs you incur. If you are currently covered by an HDHP and have not opened an HSA, talk to your insurer to see how you can get your savings account set up. If your HDHP is employer sponsored, contact your HR representative to find out if the company has already set up an HSA for you as a part of your benefits package. As always, reach out to your RINO financial planner with any questions you have about HSAs, HDHPs, or tax strategies for managing your accounts. And until next time, RINOs, remember, it's always a good time to cash in with Cassian.